We're Hyperion. We're unashamedly growth managers. I'm pretty sure you all know, how and why we invest. Missions and values, I won't bore you with that. Have a look at that, the graph on the side. That's the really exciting thing. So you can see there that only about 9% of the FUM of that 18 odd million that we run has come from net inflows from our investors. That's including our institutional client base as well. About half of it's come from market returns, and roughly the other half, or 40% or, has been the alpha generation that we've been able to produce for our investors, who are in fact your clients, over this 23, 24-year period that we've been investing in growth as a style equities. So we're very proud of that track record that we've been able to produce for our investors, which I said are your clients. How do we do it, and what are we really looking for? Well, we're really looking for what we call new world businesses. We do have the global product, but we also have the two domestic products which have been running since 2002. And really what we're trying to look for are disruptive technologies and strategies, companies with sustainable competitive advantages, if they're founder operated, you butte, but also capital light businesses and truly large addressable markets. Remember that, because we'll touch on that later. What are we trying to avoid? What we call old world businesses. And these are companies that effectively make up pretty much your top 20 on the exchange here in Australia. So it's your banks, your miners, your telcos, your services business, a couple of tunnels, supermarkets and so on. These companies are highly reliant on economic growth and outside factors for their success. They're not really controlling their own destiny by innovating and bringing new products to market. And that, to us, makes their predictability of earnings actually quite weak, especially if you want to have a growth mindset. But what are we also trying to avoid? It's new fads, early stage startup concept companies, things that don't really have any sustainable competitive advantage or are way too early in their growth cycle for us to be taking a chance on their execution. Thinking differently, we've often talked about the two, inefficiencies in markets that we like to exploit: time arbitrage, holding companies for longer periods of time and taking a long-term view. And also the quality anomaly, finding those businesses that are doing something special or different. But what we're also trying to exploit as well is what we call a power law, and trying to build our portfolios to where returns come in the marketplace. Now, we're all taught in school that everything comes in this nice orderly bell curve, and try and be in the middle or on the tails and you'll be fine. That can't be further from the truth with equity returns. So you can see on the left-hand chart there is effectively your power law. That's that, the scoop that goes up to the left. What that's really basically telling you is that equity returns come in what we call, or are most familiar with, the 80-20 rule. In equity markets, it's actually a lot more concentrated. That's about 95-5. And so we want to be able to be living in that tail and finding that 5% of businesses, it's actually much shorter in Australia, 1% of businesses that are able to produce 90% of the returns or 99% of the returns. And you can see the domestic product over the 23 odd years that we've had it unitised since 2002. Have a look at the bold text at the bottom right. We've owned about 85 companies along that journey. Over 50% of the value, the total value created, has come from the top 5 positions, the majority of which we still own today, which is realestate.com, Macquarie, Seek, and WiseTech. 100% of the value has come from 37 of those positions, meaning that about 48 have netted to approximately zero. So it is very important that you can identify these quality businesses and have a structured framework to be able to place them in a portfolio context and own them for long periods of time. You can see over the past 12 months, this chart might look familiar. It is a power law. We've been allocating capital to our highest risk-adjusted returns. The top weight can arguably go to 13%, but for operational purposes, it's around 11 or 12. The top 5 will be about 40 to 45%. Top 10 will be about 60 to 65%. You have a body of positions there for companies that are probably going to battle for capital in the future. And then also a tail for businesses that may have some cyclical or some structural problems might be starting to come into. And you can keep them at a really low weight, 1%, 2% or thereabouts, that aren't going to have a meaningful impact on your performance over long time periods. You might have seen this chart before. It is our long-term thematics slide that helped to diversify our portfolio out. There's about 12 of these long-term thematics. It's not the tail wagging the dog or the dog wagging the tail. We are bottom-up investors. We are primarily looking for high-quality businesses that can sustain their growth over long time periods. But the structural tailwinds that we can identify through these thematics These businesses generally have one or some of these identifying factors. And it can really diversify out that concentrated portfolio that we have in that power law type setting. Now, we own 24 businesses in the Australian product at the moment, and it is concentrated, but when we actually break that out by business segments, reportable business segments on the EBITDA line, you can see that there's 52 individual businesses within there, no more averaging than around 2% each of those business segments. So even though it is concentrated, it is still a very diversified portfolio, reducing the risk for our investors through that as well. Now, remember I spoke about truly large addressable markets. If we look back, what's that, about 5, 7, 8 years now, last reported, June 2017, about 55% of the revenue from our portfolio came from domestic sources. Fast forward to the end of financial year last year, 77% has come from an international source. So just because these companies are listed in Australia doesn't mean they don't have a very strong global footprint and dominant footprint. And again, diversifying out that risk of only being in that home bias, which a lot of businesses that are listed on the exchange have. Reporting season has been, you wouldn't know it if you had a look at on-market share prices. It's actually been really good. And we've been really happy to find a new company to invest in over the last month or so, which is Chemist Warehouse. I'm sure we're all aware of Chemist Warehouse and just how fun it is to go in there and go shopping. Maybe. What Chemist Warehouse has is a really strong distribution network. I don't know if you've gone overseas recently, but if you have a look at perfumes and colognes and cosmetics and so on in your duty-free shop, they're often 30, 40, 50% more expensive than what Chemist Warehouse has. So they have absolute price leadership in some of those areas. Also, these large fashion houses and cosmetics houses need the Chemist Warehouse footprint to be able to distribute their products into Australia. So there's a lot of market leadership there. Their growth actually looks pretty good, almost double that of current competitors, and we can see in time that they'll be able to increase that to 13 to 15% with some add-ons. It's a low-cost disruptive business model as well. There's about 660 stores in Australia and New Zealand. We can see that getting closer to 1,000 over the long term. So a really high-quality business that is growing almost double market rate and taking a lot of market share off your Coles and your Woolworths and some of their other competitors in those soft pharmaceuticals. Over to WiseTech. It's been in the news quite a fair bit recently, and it's always disappointing to have some of these governance developments pop up through time. We've worked with the company for a very long time, over the 10 odd years that we've owned it. But even over the last 6 months, I think we've probably had about 7 or 8 contact points with past board members and current ownership as well. It's always difficult to work through this, but you'll always fall back on a couple of principles. Has anything illegal happened? At this stage, no, which is pleasing. And none of the civil things have really come to a head at the moment. But what we're really comfortable with is the underlying growth rates that the business has still been able to produce throughout this turbulent period. If you had a look at their last result, it came out a few weeks ago, they've still got about 20% organic sales growth in their core business cargo-wise, which is phenomenal. They've also signed 2 large freight forwarders, specifically in Asia and Japan, which is really pleasing to see through this whole period. And while we're having contact with the company, we're also having a lot of contact with their customers. And there's been no faith lost from the customer base with the noise that's been happening with some of the governance or ownership issues with WiseTech at the moment. And so we'll continue to maintain our position in WiseTech so long as the execution and nothing nefarious continues to happen there. Other reported season insights, Guzman & Gomez, which we purchased quite a while ago now, had its first result to market, doing really well, growing at around 12 and a bit %, which is really pleasing to see. In line with the prospectus, they continuing their store rollouts at a constant rate. What's really also pleasing to see is they're probably one of the only major fast food chains that's got positive growth versus your McDonald's, your Hungry Jack's and your KFC. So really good to see that they're continuing to take market share from those players. Pro Medicus, phenomenal business. It's probably done too well in the short term on share price. So we've been reducing that weight as the IRRs started to come down with the price appreciation. Still a brilliant company, probably just gone a little bit ahead of itself on the short term. Domino's, we've owned that for probably 20 years. We think we've got the weight correct with that company. It's 1 or 2% percentage point weight. New management's come in, they've shaken things up, they've closed a couple of hundred stores in Japan, trying to get the focus back on profitability, which is really pleasing to see. We're probably 6 months away before we actually start to see some true turnaround there. And so we'll maintain that lower weight and work with the company until we start to see that profitability come back. And Block is a phenomenal business. Their seller terminals doing exceptionally well, Cash App's growing massively. It's very rare that you can see businesses that have earnings, sales, and margin expansion, and the share price go down. So we're still maintaining our weight in Block, and we think it's a phenomenal company that's still grossly misunderstood by the marketplace. Performance and opportunity. So this is our alpha generation on a rolling 6 months basis, going back to 2002. Effectively, what you want to see is alpha generation on the top end of the line. And if you look at the periods below the line, you can see very sharp, recoveries, when we've had those drawn down periods. Effectively, what we're really trying to say is here, if there's blood on the street, buy Hyperion. We have a very good track record of rebounding past some of these drawdown events. A lot of the feedback that we get from a lot of the sales team is, oh, can't touch Hyperion, it's gone too far. Or, don't know about Hyperion, there's been a drawdown. These are some of the best times that you can allocate capital to Hyperion, is when you have some of these technical retreats through time, which we're seeing today. The reason we've got confidence that our portfolio should move forward through time is the EPS growth that we've been able to compound over that 20-odd year track record. Historically, we've grown at around 10% per annum on EPS growth. We're forecasting around 18% per annum versus the market running around 3 or 4%. And why is earnings so important? We've broken down the return profile that we've been able to produce for the domestic product and also the index. As you can see, of that 13% performance over since 2002, the vast majority of that has come from earnings per share growth. We've got a little bit of dividends. Obviously, it's a very favourable environment here in Australia for dividends. Don and Plato do exceptionally well of harvesting those. But it's not really the dividends for us that is going to drive the capital growth. It's not PE expansion or contraction. It's not, and you can see the same for the S&P, ASX 300. Obviously, dividends playing a very large role in the return profile there. So what we're really excited about is the long-term view and long-term valuation for our fund, which is our internal rate of return, which is forecast over 10 years. It's historically run at around that 13% mark. On today's pricing, we're looking at around 18% per annum forecast out over the next 10 years. And what that really means is if we're correct and our valuations come to fruition, 18% is roughly the return profile that we'd expect for this product over long time periods. Now, Hyperion has a pedigree of being able to produce alpha over very long time periods with that 10-year forecast internal rate of return. But even more recently, yes, we've had some really strong performance in the last few years, but I'd challenge you to look at our 5-year numbers, which effectively encapsulates 2019, which is the last year of normality, to where we are today through that whole period of volatility and interest rate rise. That 12.3% is larger than our 10-year numbers, which is greater than our 15-year number, our 20-year number, our inception number. And there's been multiple economic shocks, GFCs, European credit crunches, and liquidity squeezes throughout that period. And we've still been able to produce strong amounts of alpha generation for our investors, who are indeed your clients. So we always like to say at Hyperion, to be an investor, you need to believe in a better tomorrow. And we'd like to invite you to join us on our journey. Thank you.